welcome to World Insight with me, Tian Wei. The program is coming to you live from Beijing on CGTN. It has been a roller coaster holiday on Wall Street. The day after Christmas Day, the Dow Jones Industrial Average surged more than 1,000 points for the very first time. This came after Dow Jones plunged to its worst December since the Great Depression. The stock market, however, is not the economy, and the U.S. Federal Reserve says that the American economy will continue to grow strong.
After increasing the federal funds rate by 1/4 percentage point to a range of between 2.25% and 2.5%, the Federal Reserve forecasts continued strong U.S. growth and a healthy jobs market in 2019. But Chairman Jerome Powell also notes a change in the national mood.
Despite this robust economic backdrop and our expectation for healthy growth, we have seen developments that may signal some softening relative to what we were expecting a few months ago. Growth in other economies around the world has moderated somewhat over the course of 2018, albeit to still solid levels.
U.S. financial markets fell sharply after the rate announcement, which included a projection from members of the Federal Open Market Committee of 2 more quarter-point rises next year. President Trump has urged the Fed to ignore financial data and not to raise rates any further based on a feeling about the economy.
Political considerations play no role whatsoever in our discussions or decisions about monetary policy. We have the tools to carry it about. We have the independence, which we think is essential to be able to do our jobs in a non-political way. And we at the Fed are absolutely committed to that mission, and nothing will deter us from doing what we think is the right thing to do.
So Jerome Powell acknowledges a mood of uncertainty, which he calls angst, but says any decisions will still be made based on analysis of economic data.
For more on the U.S. economy and its relations with the stock market, we have in our Beijing studio John Gong, professor from the University of International Business and Economics. In New York, we have Max Wolf, professor of economics from the New School University in the U.S. Welcome to both of you, gentlemen. Shall I say an early Happy New Year to both of you?
Thank you.
But certainly, the stock market has been quite dramatic at the end of the year 2018, isn't it? Professor Wolf, what's your takeaway from the drama over the past few days?
Sure. So great to be here, and happy holidays to you as well. Always a pleasure to join you. Look, I think what we've had here is an excessive confidence in both the U.S. economy and the U.S. market crashing pretty hard over the last 3 months into the realities of both the U.S. and global macroeconomic situation with the usual sort of steps. So one is the suspension of disbelief. We did that a long time. Then there's a sort of angry reckoning with the reality that creates a lot of volatility. And then there's the beginning of probably a slower grind downward. But that grind downward began with sort of fantastic slides. And across most of last week, there was a story of pretty massive sell-offs, and then we got a big pop on a very low volume day, and what that means is people saw an opportunity to make a little bit of more money to sort of make the year and the quarter look better when there weren't too many people in the market, and there was some short covering or people trying to get out of positions that looked like they had done about as much as they could do. And I would urge people not to look at one day and forecast too much about the future off one day.
Right. Over the past few days, Professor Gong from Beijing, we heard the stock analysts in the U.S. are persuading people to buy because this is what they consider as the best time to buy when the prices are really low. And some explain, as Professor Wolf did, this rebound. It's a very interesting separate case. Our program is not about just the stock market, but it's more than that. What does this emotional roller coaster, shall we say, which is quite often if you look at the stock market for a long time, but at this time, how should we understand this, Professor Gong?
I would add a technical interpretation of the stock market performance. I mean, if you look at the Dow Jones Index over the last 10 years, starting from 2009, this has been a very powerful bull market run-up. It has an increase from 8,000 points up all the way to 25,000 more. On average, that's about 12% a year annualized growth rate. So this is actually a very decent performance, and it's probably one of the longest bull markets ever in American history. So it's not surprising at this point that we are seeing a sort of a top formation pattern now. I think throughout 2018 it has been a correction, is at the top forming pattern, and now it's going back to a correction mode. And I think from a technical perspective, I don't think the bottom has we have seen the bottom yet. We're probably going to see sort of trading sideways or maybe even further dipping in the next few weeks or so. I think I wouldn't advise people to buy at this point. I think, but aside from all this, I think the news certainly are driving this as well. I mean, the behavior of this president, and look at the fundamentals of the U.S. economy. We're starting to see things slowing down. So
what about the fundamentals of the economy, Professor Wall, from your perspective? Of course, there has been a lot of administrative measures through tax cuts and some of the other ways earlier in order to boost the economy, and that is why also when it's coupled up with some of the major policies adopted earlier with this upswing of the U.S. economy, things are very good. But in 2019, will that boom continue? Will the jobs continue to be created? That's certainly an interesting question mark. Professor.
Yeah, absolutely. Look, I think we did a lot of short-term policies that worked very well for 6 to 18 months, and we've sort of begun to see the air come out of that balloon already. I don't think 2019 will be so good. The tax cuts weren't paid for. We're going to run $1 trillion deficit this year. And the truth is that American businesses didn't reinvest as much of that money from the tax cuts as we had hoped in building up their productive capacity here in the U.S. They did some, which was good, but probably not enough. And what everyone clings to here is the information around employment, which is certainly good news, and new jobless claims. What everyone forgets is that our economy has shifted from one defined by traditional work, which we still measure, to one defined by independent contractor status, which we don't measure. So we celebrate this whole new economy, but we still only measure the old one. And I think we're going to see the folly of that when this economy, both on a look-back basis and a look-forward 2019 basis, turn out to be quite a bit less strong than has been discussed and agreed.
Professor Gong, of course, the U.S. economy is always one of the most important factors in the global economy. Now, when you see, as Professor Wolf analyzed, the possible consequences of the current policy 2019, how is it likely to feed to the reactions of the other economies, China included, which is now, right now, in the apparent trade war with the U.S.?
I think from a global perspective, I think the United States economy is still relatively strong. I mean, the fundamentals are still fairly robust, but we're starting to see signs of strain in many emerging economies, especially as a consequence of the Fed raising the interest rate and the dollar getting stronger. And the World Bank has come out warning that this bull market is getting to the towards the end of the very long bull market run-up, and we are starting to get into recession. So these are very cautionary notes, but relatively speaking, the U.S. economy is still relatively much better than other economies with its employment figures and with its overall GDP growth compared to other time. It's still
as you earlier analyzed already, Professor. Now we are also joined by Christopher Versace, who is a portfolio manager from the Streets Trifecta Stocks. Welcome, sir, to our program as well. One of the interesting things people have been debating about is the relationship between the heads of state and the Federal Reserve chairman. I understand in legal terms there has been some very vague description as to what exactly their relationship is, particularly whether the president should give order to the Federal Reserve chairman, the central bank chairman. Mr. Versace, from those who are working on the Wall Street, what do you make of the current debate?
Well, there really isn't much of a debate. I mean, the Fed chairman is independent of the president. And I think what you're referring to is some of the speculation, most notably reported by Bloomberg, that President Trump was talking about not being very happy with Fed Chairman Jay Powell. What we've seen over the last couple of days is the White House actually dispel that notion. I think the issue really stems from the fact that
did the White House dispel that notion? Did the White House dispel that notion, or did the Treasury Secretary dispel that notion, despite of the fact he also suggested that the president was not happy with the Federal Reserve Chairman's attitude and measures so far? So that's a difference.
Well, remember, the report over the displeasure came from Bloomberg, and yes, the Secretary of Treasury came out saying that that was not the case. So, but the bigger issue here, though, is the rate at which the Fed is going to, if it plans to increase interest rates in 2019 as it tries to remain data dependent. Remember, they have reduced their expectations from 3 rate hikes in 2019 down to 2. The president, just seeing the speed of the overall U.S. economy, is questioning the need for those 2 rate hikes. I think he would like something perhaps a little softer in order to help keep the current expansion underway. The one background on this is that the Federal Reserve has historically done a very good job of boosting interest rates into a recession. That doesn't mean we're expecting a recession next year, but we are seeing signs of slower growth. That, I think, is what has the president alarmed.
Professor Wolf, correct me if I'm wrong. Since 2005 until now, the Federal Reserve has been raising interest rates to about 9 times. Is that the right number? And this year, of course, certainly there has been some contribution to that overall volume. So, Professor Wolf, how do you look at the reactions of the economy from the Federal Reserve, and how do you see from the White House and also the central bank chairman, what's their exact relationship should be according to the definition?
Sure, so let me start with the relatively easier one. The chairperson of the Federal Reserve, now Jerome Powell, replaced by and picked by President Trump, has 2 mandates. One is to do everything possible to create an environment conducive to full employment, and number 2 is to manufacture and help to induce price stability. Those are, in fact, the only 2, and one of the successes of U.S. financial markets and the reasons for their depth and historic global prestige is the independence of the central bank. It is very counterproductive and quite a bit unusual, if in style, maybe not in substance, but in style, to have a president be so openly critical of his own recent selection, particularly in a moment of turmoil. So that's definitely an issue. We saw the U.S. Federal Reserve cut interest rates to extraordinary, both internationally and historically low rates in the 2008-2009 recession, sort of severe recession and market asset deflation fears, and then keep them there for about 10 years. Now we've seen multiple quarter-point rate hikes, but we're still way below any kind of international or historical norm for interest rates, still very low. And then just add one other thing, is probably the bigger policy instrument the Federal Reserve has is normalizing the balance sheet. People tend to forget that going into the 08-09 crisis, the Federal Reserve had an $800 billion balance sheet, which now sits at $3 trillion. And so normalizing that back down, selling another $2.5 trillion worth of assets, is actually a big challenge and could do more kind of tumult, could induce more tumult in the markets. But I do also think that at some point, if the economy is anywhere near as strong as most folks seem to think it is, we need to be able to have a functioning economy without massive, constant monetary stimulus. And what we're doing is trying to figure out how to do that. And what doesn't help is the overt undermining of the authority or creating nasty debates about the independence of the Federal Reserve in such a difficult context, because by any measure, Mr. Powell has a fairly challenging job right now.
Mr. Versace, if, according to the explanation of Professor Wolf, it seems that the mandate of both the heads of state of the United States and the chairman of the Federal Reserve in the long term actually are very similar, if not the same, with one another. So what exactly is the nature of the debate right now?
The nature of the debate is the speed at which the Fed is expected to increase interest rates in 2019. Again, if we look at the preponderance of economic data, not just in the U.S. but around the globe, we see the global economy slowing. Case in point, I believe November industrial profits in China fell year over year. This is the first time in 3 years.
Right.
If we look at a lot of the IHS market data, particularly flash PMI data for December, we see across the board slower order growth, slower backlog growth.
That's well understood.
Indicating that, yes, the recent bout of data continues to point to a slowing. So the real crux of the question is, what is the right speed at which the Federal Reserve should be boosting interest rates? And at the same time, the current expansion is fairly long in the tooth, and the Fed is most likely trying to get as many monetary policy tools back in their toolbox for the next eventual recession, depending on when that happens. And there are some out there, according to CFO Magazine and Duke University, that we could see signs of a recession as early as the fourth quarter of 2019, perhaps in 2020.
Yeah.
So we have a little bit of a time game here while the economy slows. So it's a question of how much can the Fed do without sabotaging the current speed of the economy and tossing it into a recession.
That is certainly a very logical and reasonable debate. As far as I'm reading over the past few days, most of the analysts are suggesting about a difficult year possibly in 2020, even though the U.S. economy could escape possibly a difficult time in the year 2019. Having said that, though, Professor Wolf, I want to have a question for you as well regarding that when a Federal Reserve chairman is trying to make his decisions about interest, about the hikes or not, the rates adjustment or not, who should he consult? Is there a procedure with which he will make his decision? How people should accept his decision, including different economic organizations, departments, related, personnel, including the president. What exactly is, according to the book?
Yes, so generally speaking, there's supposed to be a lot of conference and discussion inside the Federal Reserve, which has a large staff of some of the most talented and qualified economists available. Also, there's 12 governors, so it's not a single individual who makes the decisions, although it's a single individual who often announces them and is either credited or critiqued with those decisions. But we can see the entire 7-person voting group. We can see the consult, all the economists, and it's a model-driven process. And I think Chairman Powell's been pretty good about trying to point to that, which is it's not really his opinion about the economy or Janet Yellen, his predecessor, or whomsoever serves next. It's really about reading an incredible amount of data into an organization full of technical expertise and letting that model drive your decision-making process. There is, of course, a little bit of art in the science, and that may be where the debate is largely centered. But we also need the Federal Reserve to both really be, and certainly to be perceived to be independent, for us to maintain our position as the deepest, most liquid home of capital markets in the world. And so there's also a long-term macroeconomic importance to the U.S. here that we should mention that's enormously important.
Professor Gong here in Beijing, the most well-known quote coming from any Federal Reserve chairman we could remember is probably from Mr. Alan Greenspan. The so-called rational exuberance phrase has been flying in the air for quite some decades, shall we say. Having said that, though, he does learn his lesson in making the economy as so-called prosperous as it could be, letting it go with its own speed. But obviously, eventually, it has to be adjusted. But it was a little bit too late for his term. So, Professor Gong, when you are looking at the job of Federal Reserve Chairman, how cool-minded this person has to be, and how much he really has to shoulder the responsibility in order for a good economy?
I think the role of Fed is especially prominent during times of economic downturns and upturns. When it comes to upturns, very cautionary about inflationary pressure. when it's in a downturn, you want to boost the economy. So it's really during these times that the Fed's role becomes very prominent. Now, back to the question about the relationship between Donald Trump and the Fed. I think, even though, my opinion is, even though Fed is supposed to work independently, and I think President Trump understands that, but he still, this is not the first time he's exerting pressure on the Fed chairman. He's been saying this, there shouldn't be a raise of interest rate again, several times in the past. And I think he's doing this deliberately. He's trying to influence the Fed's
That's exactly the issue, isn't it?
Right. He's trying to exert some political pressure here. He doesn't care about anything beyond 2020. I think his time horizon is very short.
Right.
He's targeting the election. He wants the economy to perform well within his time frame.
Right.
But Fed's job is very different. They have a much longer time horizon.
Right. Before we go, how should we see it? The others' economy, what kind of attitude and what is the perception they can look at the debate now going on in the U.S. between the President and Federal Reserve Chairman and the direction of the U.S. economy? One sentence or two from every one of you, if we can, gentlemen. Mr. Versace first.
I think that we're seeing a big reset on expectations for the economy, both in terms of GDP growth as well as corporate earnings growth. And I think that, as we head into 2019, for U.S. investors, is the big question as we get to what is the real speed of the economy, what is the real speed of earnings growth. And I think that will be the influence over the market over the next couple of months as we get through December quarter earnings.
Professor Wolf, one or two sentences, please.
Yeah, so I think the two big lessons that we're starting to learn under some duress here are the whole rest of the world does matter, and that things are a little bit less good than we thought, still pretty good, less good than we thought, and we need to prepare ourselves to be more long-term minded and more globalization integrated to go forward into 2019-2020 with the best possible economic security.
Professor Gong, last but not least.
I think we're entering a very critical time that the world economy is starting to see signs of recession. I think it's the time for President Trump to wrap his trade war. Let's reach an agreement with China and move on. This is a very bad time to continue this unnecessary and totally unwarranted war.
Well, with that call for peace, I guess we wrap up for this round of discussion. I want to thank the three of you gentlemen for being with us during the holiday season. John Gong, Max Wolf, Christopher Versace, really appreciate it. Thank you so much. Have a great 2019. Thank you.
Thank you.